Hi, I'm Dahlia. I'm a finance grad who spent 7 years working in asset management and sales in London and then quit to start my own business. If you're new to my channel, it's all about tips for personal finance, investing, business and property. Today I'm doing something a bit different. I'm going to show you what's actually in my investment portfolio. Now, before we start, this is not financial advice. It's just what I personally invest in based on my goals, risk tolerance, and time horizon. But I think seeing real examples helps make investing feel a little bit less mysterious, especially if you're new to ETFs or building a portfolio yourself. So let's dive in. I'm going to break down each fund I hold, why I chose it, and how it fits into a diversified long-term strategy. Firstly, I'm going to give you a very short investing terms crash course. For the beginners out there, let me explain a few terms I've already used so that you can understand the rest of this video. A portfolio, in the case of investing, this word just refers to a collection of different things that you invest in. Diversify means investing in different types of assets so you don't have all your eggs in one basket. So if one type of asset goes up in value, then another asset in your portfolio might go down in value at the same time. Therefore, you're spreading out your risk and reducing your losses. An asset class, in its most simplified form, just means a type of investment with similar characteristics. For example, stocks are an asset class, bonds are an asset class, commodities such as oil and gold, etc., all fall into that category. An ETF stands for Exchange Traded Fund, which is essentially a fund that you can buy in shares on the stock market, which allow for greater amount of flexibility and liquidity than investing through sending your money to a fund manager, for example. Through using an ETF, you can even do the investing yourself if you have a stocks and shares account. I use the Moneybox app in the UK to invest in the portfolio I'm about to go through with you. This is not an ad, there are many similar apps. I've just always used this one. I think it's really user-friendly and easy for beginners. And it offers a good range of funds from different providers, so you're not locked into investing in just one company's funds, like Vanguard, for example. If you want to get started with investing with Moneybox, I'm going to link it in the description below. The first fund I have in my investment portfolio is the iShares European Shares ETF. This is at 15% in my portfolio. This fund invests in large and mid-cap companies across Europe. Think names like BMW or LVMH. The reason why I hold it is that Europe often gets overlooked compared to the US, and it also adds diversification outside of the pound and dollar. European companies tend to offer solid dividends and operate in sectors like luxury goods, pharmaceuticals and energy, which can balance out a tech-heavy US exposure. This fund offers a steady, slightly more value-oriented region of my portfolio. At the moment, I personally think the US market is a little bit overvalued given the huge weighting towards tech shares in their index, as well as the declining employment figures. So I'm expecting a market correction soon for the US, hence diversifying more into European shares to hedge against a potential correction. So a stock market correction, for those of you who don't know, is when the market drops 10% or more from its latest high. Next up, I have 15% of my funds invested in the Vanguard High Dividend Yield ETF. This is one of my favorites for passive income. This fund focuses on established companies that pay consistent dividends. There are actually 579 companies in this fund across many countries and every sector. So it's about as diversified as you get. I really like this one because dividends give you actual cash flow even when the market is a bit volatile. Over time, those reinvested dividends compound really nicely to help you build up your wealth. Next up, I invest 15% of my portfolio into the Vanguard US Government Bonds ETF. Bonds might not sound very exciting or have the kind of growth that you're going to get from stocks, but they are the backbone of a balanced portfolio. Bonds are basically loans to the US government. They're one of the safest borrowers in the world. So having bonds in your investment portfolio acts as a stabilizer for your portfolio. When stock markets fall, bonds often hold in value or can sometimes even go up. I have recently increased my allocation in bonds as I'm expecting some market corrections or volatility over the next year. So even though bonds have a lower percentage return than the stock market, they provide a good hedge in case of market falls. This part of my portfolio helps reduce overall volatility and protect the downside. Basically, that means I'm giving myself a little bit of insurance should the stock market start falling. The bonds will retain or even increase in value. This is probably a good moment in which to say that I'm in my 40s, so my portfolio of investing is slightly more on the conservative side. So what does that mean? I'm tending to invest in things that are likely to be less volatile over the next 10 to 20 year time period, after which is more realistic for me that I'm going to start wanting to take money out of my investments. If you're in your 20s or 30s, you can take a much less cautious approach, put a lot more into the stock market itself or more volatile stocks, because you've got more time on your side for the stock market and the value of your investments to recover. You have to remember as well that the average rate of return across all stock market indices is 7%. So whether you put your money into risky or less risky stocks, it's probably going to even out over time. So I'm just personally choosing to use a less risky approach. My next investment is 10% in the iShares Physical Gold ETC. An ETC is an exchange traded commodity. Similar to an exchange traded fund, it just allows everyday people to invest in commodities without having to hold physical gold or whatever other commodity it is. This is not a gold mining stock. It's an actual exchange traded commodity backed by real physical gold stored in a vault. I hold 10% in gold because it's a hedge against uncertainty. When markets crash or inflation spikes, gold tends to hold its value. For example, during 2020, when everything else dropped, gold prices rose by nearly 25%. Now, gold itself, it doesn't produce an income, but it gives you peace of mind and diversification beyond the other types of asset classes. And it can also go up in value as well as generally being good for holding value. Let's talk about why I hold gold and why it's doing so well lately. Why people hold gold as an asset class. Gold isn't just something pretty to wear. Over the centuries, it's become a financial tool, and here's what makes it special. Gold is an inflation hedge or a store of value. It tends to hold purchasing power over time, so when the price of goods and services go up with inflation, currencies often lose value, but gold, being a real asset, resists that depreciation. The second reason to hold gold is that it's been historically a safe haven and crisis buffer. During times of political, financial, or economic uncertainty, investors flock to gold, and it often moves in a different direction than stocks or bonds, so it can cushion your portfolio when other assets are under pressure. Lastly, gold as an investment is a diversifier, and it has a low correlation to the prices of other assets. It has a historically low correlation to equities, bonds, or property. That means when those are falling, gold holds steady or can even rise and balance out your portfolio. For example, in some research carried out by Invesco, they showed that gold's price is often driven by completely different factors than equities or bonds. The next fund in my portfolio is the Old Mutual Global Shares ESG at 10%. This is an exchange-traded fund that invests globally, but it also screens for environmental, social, and governance standards. So companies that score well on sustainability and ethics. ESG funds typically exclude controversial industries like tobacco, gambling, or weapons. I like that it lets me invest in global growth while still aligning with my ethics and values. ESG funds have performed competitively with traditional global funds recently, especially as more investors are starting to prioritize sustainability. Next up, I have 10% in the Fidelity Global Shares Fund. This is a classic broad fund tracking 1,500 companies worldwide in 23 different countries. It's like saying, I don't want to pick the winners, I just want to own the whole market. It's like having a tiny slice of 1,500 different companies in your investment portfolio. So you'll find all the big names in there like Apple, Amazon, and Tesla, for example, and it's a simple way to benefit from global economic growth. I call this my core holding. If I could only own one fund, it would probably be something like this. It spreads your risk globally and across every sector, so you don't have to put all of your eggs in one basket. Next up, I'm holding 10% in the UBS S&P 500 ESG fund. This is the S&P 500 index, of course. The 500 largest companies in the US, like Apple, Microsoft, Amazon, Nvidia, and pretty much everyone will tell you to invest in the S&P 500 for steady 7% year-on-year growth. Recently, I've decreased my allocation to the S&P and increased it towards more global funds, just because my personal outlook on the US is that it's slightly overvalued at the moment. So I'm trying to move my investing towards a more global portfolio, which still of course includes a lot of US companies. So I'm not taking my investments out of the US, I'm just spreading them around a bit more. The ESG version of the S&P 500 just filters out a few companies that don't meet sustainability standards and also ethical standards such as weapons manufacturing. The ninth investment in my portfolio is having 10% in the Vanguard Life Strategy Fund. This is a great all-in-one option that blends stocks and bonds. I treat it as my set and forget component of my portfolio. It's ideal for anyone who doesn't want to constantly rebalance or manage separate types of funds. It gives you exposure to global equities, bonds, and a little bit of the UK market. It's super diversified and it rebalances automatically. Lastly, I have 5% in an AI and technology ETF. This AI fund also happens to be an ESG fund, so looking at sustainable and environmentally driven companies with better values than most. This allocation is higher risk, but also potentially higher reward. It focuses on companies driving AI, artificial intelligence and automation like Nvidia, AMD, Alphabet, and Microsoft. I added this because AI isn't just a trend, it is transforming every industry, but I keep it at a very small portion because it is very volatile as well. Again, I recently decreased my allocation in this for similar reasons to what I outlined above about decreasing allocations in the US and tech. I do think that even though AI is such a huge growth sector at the moment, a lot of people are speculating and it's potentially overvalued. So even though it genuinely is the next big thing, as a more cautious investor, I'm only doing 5% in AI in this particular portfolio. I have a separate stocks and shares ISA where I buy individual shares in AI companies and spend less money on it. And for me, that is a more speculative investment. Whereas what I've gone through today is the core of my investment portfolio. So that's my portfolio. If we zoom out, here is the mix. I've got around 70% in equities or stocks for long-term growth. I've got 15% in bonds for stability. I've got 10% in gold as a hedge, and I've just got 5% in AI and tech for its huge growth potential. This portfolio is giving me geographic diversification across the UK, US, Europe, and global assets. It is giving me diversification across asset classes, so I've got stocks, bonds, and gold, and I've got pretty much every single sector, so for a really good diversified portfolio. This portfolio, as I've said, is a little more on the safe side because I'm in my 40s, so I'll probably only be investing in these for the next 20 years or so before I start living off these investments. So I'm being a bit more cautious than I would be if I was in my 20s, where I would have a longer time to take risks and put money towards a more risky portfolio that has potential for higher growth. If you're in your 20s or even 30s and you've got a much longer investment horizon, I would definitely weight more of my investments into riskier stocks such as AI and tech, or basically anything that's more volatile, because you've got time for the market to go down and then back up again. Personally, I'm sticking with a more cautious strategy so I can protect my money over a shorter time frame. Thanks so much for watching. I hope you found this interesting. If you've enjoyed this video, please give me a like and hit subscribe. I'm going to be dropping new personal finance, business, investing, and property videos every week, and I'd love for you to join me on this journey. This is Dahlia. You're watching Get on Top with Dahlia. Let me know in the comments what you're investing in and if this video has helped you. Ciao.